Okay, folks, there's no denying it. When you're sitting back on your fat, lazy ass leading into this holiday season, there's nothing any of us can appreciate more than that juicy passive income, those wonderful dividend checks those companies be paying out. Because let's be real, when you're investing your hard-earned dollars, you got to put it into real estate, but then you got to work for that real estate, investing it into a startup, your own business, a lot of time involved when you could just put it into a publicly traded stock that pays a healthy dividend and yes, even outperform the markets during these tumultuous times. As today we're reviewing 20 dividend stocks that are outperforming this year and pay pretty generous yields. And we're not talking about some fast track loophole system with an options ETF yielding 10% that underperforms the market, or damn it, the neighbor's kid telling you to buy that NFT or that crypto project that offers some beautiful APY. No, this is a true working system, and these are stocks I would personally be proud to own. And damn it, I do own, whether it's through my own individual holdings or some of my ETFs. If that is a conversation you think you'd appreciate, hit that like button, folks, because taking a look at my portfolio going into December here, right at the very start, we're worth around $367,000, and all of my stocks are going to be paying dividends between now and basically January, making me around $1,000+ I really don't think there is a better time than during the holidays when you're buying gifts and you want to sit and relax, collect those bonus checks from your work and those bonus checks from these wonderful dividend companies. And just taking a look at my individual brokerage accounts before we kind of analyze these 20 stocks, guys, I have all of these set up on a drip, and currently the markets are starting to pull back, which makes me very giddy inside because I want to be buying my dividend stocks not only when the yields are higher, but when the stocks are obviously suppressed, right? So take a look at this, because VDY is going to be paying out, VOO is going to be paying out in the next month or so, which I know the S&P 500 doesn't pay the highest yield, but I do like that exposure to those tech companies that are relatively suppressed this time around. My RRSP, SCHD, VYM, these have been the best performers, but are also starting to retract a little bit here, folks. Now, if you do like tracking dividends, if you love the way my portfolio overview looks, and you're kind of a dividend-focused investor, support the channel. We are launching Excel sheets, Google Sheets, iCloud number sheets, so you can track your own dividend stocks and your portfolio automatically, guys. And if you use coupon code DIVIDENDS right now leading into New Year's, you're going to be able to get this at 30% off. It's basically like $10 Canadian. So if you're a US citizen, it'll work for you as well. And damn it, that's like $8 US. So let's get right into this, folks. With numero uno, starting on the US side of the border, I guess we got to talk about the oil giants. Now, I'm not saying any of these stocks are a buying opportunity today. There are obviously some better deals around the corner, but I just want to look at the best performers, these true recessionary proof kind of stocks that are paying pretty decent yields. And Exxon, I know oil companies, guys, they've just been exceptional this year, with Exxon up 63%, currently paying a 3.5% yield. When we're talking about this geopolitical event, yes, war, damn it. I know you can profiteer off that stuff while sitting on your ass over the holidays, is kind of a weird moral dilemma, but nonetheless, Lockheed Martin here, guys, the producer of rockets, jets, and a lot of things in between, only paying about 2.46%, is up 36 damn percent this year. That one's definitely kicking out some early Christmas gifts. Look at Merck and Company. Let's review some of these healthcare companies coming out of the pandemic. A lot of these are responsible for, making those vaccines. Unfortunately, Pfizer did not make this list. These companies are responsible for everything from like Botox to basically cancer curing drugs, with Merck and Company currently up 41%, paying a 2.68% yield. Currently, we've got Amgen in here, up 24%, paying 2.75%, and AbbVie, I know this is a fan favorite amongst the community as being one of the higher yielding pharmaceutical companies, paying 3.64%. Now, flipping a little bit here, IBM did make this list, and I do hold this. I think it's a big proponent of SCHD along with a lot of those healthcare stocks. But IBM, even though it's been a great performer this year, up 8.2% with a wonderful starting yield of 4.48% over a 5-year period, this one's been kind of a lackluster performance. But these are what I would call your retirement stocks, your sleep easy at night kind of companies where you're not nearly as concerned about the high-end performance. And I'd always state, guys, don't always chase the highest yields. You kind of want a balance of the lower yield stocks and the higher yield stocks, because in moments like when the market becomes kind of tumultuous, you kind of get the best of both worlds. You'll still end up performing well. And some of these companies that made that list would have to be Coca-Cola, guys, yielding 2.78%. Currently up 6.8% this year. Pepsi, another fabulous one that just announced they're going to be buying those Tesla tractor trailers. The big announcement of the first release of those tractor trailers, guys, just came out. Pepsi's going to be the first deliverer of those. So, and is up 4.65% year to date. McDonald's, yes, a company I've been in and out of, one that I wish I held on to because it's basically flat for the year with a 2.25% starting yield, but over a last 5-year period, my goodness gracious, this is a steady Eddie to just reliably bake your way into a healthy retirement. And then finally here, another healthcare company that's doing a bit of a spinoff with one aspect of their company is Johnson & Johnson, probably one of the largest pharmaceutical companies globally. And on top of that, this has been a fan favorite in the dividend investing community. I mean, you're going to hear about this one again and again. You know, the 5-year performance doesn't really stand up to some of these other companies, but it does really stabilize your performance during these tumultuous markets. But I got one more. This is a bonus one that I wanted to add on because I do love the utility sector, and one of my favorite utility stocks because it's highly related to nuclear power. They've got a really diversified portfolio of utility-based assets, and that's Southern Company, which is currently flat for the year. It did have pretty incredible performance up till recently, but again, we're talking about almost a 4% starting yield, and the 5-year performance is just stellar, right? So let's do a bit of a flip, a 180 here right into the Canadian markets, because I know many of my viewers are Canadian investors. And Alimentation Couche-Tard, yes, this French-based company is up 16%. The yield sits pretty low at around 1%. The 5-year performance is just kind of jaw-dropping, to be honest, and I've not been the biggest fan of this company because, you know, they're really expensive stores. They're like your convenience stores. You go in here, you're overpaying for your Doritos, anything you want to buy at a convenience, you got to pay for that convenience, but damn, it is really conveniently benefited Alimentation Couche-Tard. So that one's on the top of the list. Let's get into this with some more pure play focused, you know, utility companies, because Hydro One was a government spinoff. The government used to own this up till about 2017 when they IPO'd, and basically this is a pure transmission line focused company. If you live in Ontario, there's a good likelihood that you're using Hydro One to supply the hydro to your house through their lines, and it's a very stabilized investment that has proved to be an outperformer this year, up 13% with a starting yield of 3%, and the 5-year performance basically since the IPO, guys, has just been utterly stellar. So let's take a look at Canadian Pacific Railway. This is kind of like your Warren Buffett favorites. You're not talking about massive yields, but again, you get a balance of all of these, and your portfolio will continue to outperform because take a look year to date, Canadian Pacific Railway, those railway lines are up 14.75%, and on a 5-year basis, damn it, 132%. Now, kind of moving into the renewable space, a stock that is on my current buy list. I'm trying to figure out how I can navigate this into one of my brokerage accounts. Has got to be Northland Power. As this thing continues to suppress in price, the valuation starts looking more and more appealing at a 3.23% yield that gets paid out monthly. It's an annual yield, but the dividend's paid monthly. This thing has been flat roughly for the year, but with that dividend yield, you're actually on the green. 5-year performance is unbelievably well stabilized. I love this company being a pure play to renewables globally, whether it's wind, solar, natural gas, some transmission lines as well. This one is definitely on my list. Now, in the real estate sector, there's very few REITs that have actually performed exceptionally well this year. In Slate Grocery, REIT yielding around 7% is up almost 8% year to date. With that dividend, you're looking at about a 15% return with a relatively okay 5-year performance. REITs don't typically, you know, there's very few REITs that really outperform the market, but we're talking about that income stabilized over long periods of time. This one would probably make the list. Moving into the financial sector, let's talk about some of these banks. Royal Bank, amongst all the large cap Canadian banks, probably one of the best performers because with the 4% dividend yield, you're kind of flat year to date, but if you're reinvesting it, you're probably green on the year with a 5-year performance. Again, very healthy, stabilized. You're not going to be dealing with the volatility of these tumultuous markets. And speaking of energy, yet again with pipelines, these would almost fall into utilities, guys. Enbridge, a massive natural gas supplier, and with pipelines spreading all the way from Alberta, damn it, down to Texas. This sucker's flat for the year, but with a whopping 6.71% dividend yield, you're actually doing very well. And keep in mind, the S&P 500 is damn near down between 15 and 20% year to date. So these things are crushing incomparable, right? But let's take a look at Pembina Pipeline. A lot of you pointed this one out to me, being another major pipeline providing company. These things have very stabilized moats, but again, 5-year performance, these things aren't going to give you the best growth periods, but they are going to give you those much higher yields. I think the starting yield for Pembina is closer to around 5%, kind of falling in line with Enbridge. So these are what you want for those higher yields. So you're getting a lot higher payout, but again, you always want to kind of balance them with those lower yields that offer a little bit better growth. And then finally, my favorite sector, bar none, for this year, because during the Black Friday sales, when I was doing my DD running around the malls, damn it, that due diligence, guys, there were lineups outside the kiosk, is probably the longest lineups amongst all the stores, including Apple for that matter, Nike. None of those things had lineups incomparable to our telecom giants. Bell here yields almost 6%, currently 5.77. So even though it's down year to date, you are still doing very well with that dividend. 5-year performances relatively flat, but you can put that in comparison with things like Rogers performing very well, 5-year roughly the same as Bell. And then my favorite of the bunch being TELUS, which 5 years has the best performance, but again, a very healthy starting yield of around 5%. I'm very excited to see what the earnings look like for these telecom giants, because I do think they're going to continue to outperform, as TELUS last quarter had record signups for telephone providers. TELUS also, amongst all the telecom giants, had the least amount of reported problems, which obviously this year, you might recall, Rogers went down, and that was a bit of a kerfuffle. I remember standing outside Starbucks. We were parked outside some of the grocery stores trying to hack their internets, use things like Bell or whoever had any other service provider. But at this point, folks, these are bar none some of the best performing dividend stocks this year. And I think it's really enlightening to see that, if you balance your portfolio with what are truly the most foundational stocks, you're not greedy. You're not chasing super high yields and option ETFs and crypto. And, you can balance this out by looking at better deals in the market when it comes to tech. You can use those dividends to cost average into some of those higher growth plays. This is what I truly love about being a passive income investor, sleeping easy at night, collecting those checks. But I'll pass that question off to you. I'd love to know what you think and what your favorite dividend stocks are for 2022.